In 1994, a group of the smartest financial minds in the world built something they believed could not fail. Not probably won't fail. Could not. They had a Nobel Prize winner. Then another one. They had PhDs from MIT and Harvard. They had a legendary trader who had never really lost. 4 years later, this fund lost more money in a single month than most companies make in a lifetime, and the Federal Reserve had to step in to stop it from breaking the entire system. This is the story of long-term capital management. Our story starts with one man, John Meriwether. At Salomon Brothers in the 1980s, he ran the most profitable trading desk on Wall Street. The best. He didn't hire salesmen. He hired mathematicians, physicists, people who saw the market as a puzzle of numbers rather than a casino of nerves. In 1994, after leaving Salomon, Meriwether decided to build his own fund. Not just any fund. The fund. He recruited 2 men who would later win the Nobel Prize in economics, Myron Scholes and Robert Merton. Their formulas were already the backbone of modern options pricing. With Meriwether's trading instinct and their theoretical brilliance, long-term capital management was born. Investors needed a minimum of $10 million just to get in the door. So what did LTCM actually do? At its core, one elegant idea: convergence arbitrage. 2 very similar bonds sometimes trade at slightly different prices, even though logic says they should eventually match. LTCM found those tiny gaps and bet that they would close. The catch: these gaps were tiny. Fractions of a percent. Almost nothing. To turn almost nothing into real money, you need one thing: leverage. Enormous, staggering amounts of borrowed money. That at its peak, LTCM controlled over $120 billion in positions, on a base of only about $5 billion of actual capital. That's leverage near 25 to 1. In some derivative exposures, dramatically higher. And for a while, it worked beautifully. From 1994 to 1997, LTCM returned as much as 40% a year, after fees. Extraordinary. Wall Street banks lined up to lend LTCM money on generous terms, almost as a badge of honor. Being their counterparty felt like proof you belonged in the room. The fund became something like a myth. People called its trading strategy the black box. Nobody outside quite knew everything inside it, and nobody wanted to ask too many questions. Success has a quiet side effect. It breeds certainty. The partners began to believe their models didn't just describe the market, they governed it. In 1997, the Asian financial crisis rattled global markets. Currencies collapsed. Interest rates spiked. LTCM's models called it a temporary distortion, an opportunity, not a warning. The firm leaned in further, expanding bets across markets that had never behaved the way its historical data assumed they would. Then in August of 1998, Russia did something the models hadn't priced in. It defaulted on its own domestic debt. Its own currency's debt. Panic doesn't follow spreadsheets. Investors everywhere fled to the safest assets they could find. U.S. Treasury bonds. All at once. This is the moment convergence arbitrage turns dangerous. LTCM's trades were built on the assumption that related prices move closer together over time. Instead, in a global panic, they move further apart. Every single one of LTCM's supposedly independent bets started losing, at the exact same time. Diversification is supposed to mean your risks aren't all connected. But in a true panic, correlations that looked separate for years can suddenly converge into one giant risk. In the first 3 weeks of August 1998 alone, LTCM lost nearly $2 billion. By the end of the month, over half its capital gone. Because of the leverage, the losses didn't just hurt, they triggered margin calls. Lenders wanted their collateral back. Now, to meet those calls, LTCM needed to sell positions. But its positions were so large, selling them moved the market even further against it. The fund was trapped inside its own trades. Meriwether began making calls, not to raise more money for opportunity, but simply to survive the week. The genius fund was running out of road. Word reached the Federal Reserve Bank of New York. This wasn't just one firm's problem anymore. LTCM's trades were woven through nearly every major bank on Wall Street, each one a counterparty, each one exposed. If LTCM collapsed suddenly, it could drag the lenders down with it. On September 23, 1998, representatives from 14 banks gathered in a room at the New York Federal, not to bail out LTCM's partners, to protect the system LTCM was tangled inside of. The Fed didn't put in taxpayer money. Instead, it organized the meeting and applied quiet pressure, urging the banks to find their own solution. After tense negotiations, the consortium agreed to inject $3.6 billion in exchange for 90% ownership of what remained of the fund. The partners who had once been the most admired minds on Wall Street were left holding a sliver of the firm they built, and a lifetime lesson in what certainty costs. LTCM was wound down carefully over the following months, its positions unwound in a way that avoided a broader market crash. Crisis contained. Barely. So what actually went wrong? Not the math. The math wasn't wrong on its own terms, it was incomplete. The models were built on historical patterns, years of data showing how markets usually behave. But markets don't always behave. Sometimes they panic. The models also assumed there would always be enough buyers and sellers to trade your way out of trouble. In a true crisis, liquidity can simply vanish. And the leverage that made small opportunities profitable also meant there was almost no room for error. Almost no room to be wrong, even briefly. Here's the deeper irony. LTCM's partners understood risk better, on paper, than almost anyone alive. And yet they underestimated the one risk that always comes for confident people: their own certainty. 10 years later, in 2008, a much larger financial system made strikingly similar mistakes. Too much leverage, too much faith in models, too little imagination for what unlikely events could actually do together. LTCM wasn't a story about bad traders. It was a story about brilliant ones, forgetting that markets are made of people, and people don't always do the rational thing at the same time. If there's one lesson worth carrying, it's this: a model that has never been wrong yet has not proven it can't be wrong. It has only proven it hasn't been tested by the right storm. If this kind of financial history is something you want more of, the quiet booms, the sudden collapses, the lessons hidden in old headlines, subscribe and I'll see you in the next one.